Welcome back to the channel. Barry Charles here. Today we're going to discuss dividend investing. You will learn the following. What is a dividend? What is a dividend yield? What is a payout ratio? Look at some strategies around dividend investing. Look at some pros and cons to dividend investing. What are some long-term dividend stocks you can start doing some research on so you can begin your dividend investment journey today towards profitability. What is a dividend? Dividends are payments a corporation makes to shareholders. When you own a stock that pays a dividend, you are receiving a share of the company's profits. If a company is profitable, management can choose to either reinvest profits into the company to help grow the business or distribute the money to its shareholders through a dividend. Dividends can come in many forms, but most common is a cash dividend, which is deposited into investors' investment accounts. For example, if a company declares a 50-cent per share dividend for the year and you own 100 shares, you'll receive $50 cash in hand over the year. Most dividend stocks generally are mature companies with strong cash flow balances to pay a dividend, as well as companies that have seen their growth potential slow down or stagnate, will pay you a dividend to try to keep you the investor in the company. A dividend can be paid monthly, quarterly, meaning every 3 months, biannually every 6 months, or annually once a year. Most companies pay quarterly, which psychologically makes most of us think you're getting paid more. But over a year span, there is no difference in dollar value if you're getting paid $100 over 4 payments or 1 payment. The only bonus is if you are reinvesting the dividend, keeping your money working for you, which we will talk about more later in dividend strategies. But it's not as simple as just buying the stock as you instantly receive a dividend. For instance, if you have bought 100 shares in Apple on the stock dividend payment date, you will not receive the dividend as you had to be a shareholder on or before the ex-dividend date, which can often be anywhere between 1 to 6 weeks. As on ex-dividend date, they calculate how many dividends they need to pay on record day for payments to shareholders roughly a month later on payment day. So don't fall into this trap. You can find information on when these stocks' ex-dividend date will be, the dividend amount paid in that period, and also the payment date at the dividend yield at marketbeats.com or nasdaq.com and many more sites. What is a dividend? Yield, the percentage return of an asset paid over 1 year. For a dividend stock, the yield is from all dividends received over the year divided by the share price times 100. So if we use Apple as an example, if you had 100 shares in Apple stock at the start of the last financial year for Apple, when they last announced their new dividend payment, the annual rate would be 82 cents per share divided by the current share price around $130 times 100. You would get a dividend yield of 0.62%, which is quite low in the stock market compared to AT&T stock. It has around 7% dividend yield. So if you are buying a stock purely for the dividend, the AT&T stock looks more attractive. But it's not that simple. Can the company afford to pay the dividend? To compare two companies, currently Apple has a payout ratio of 18.5% on current net income compared to AT&T high payout ratio of 66%. What is a payout ratio? The payout ratio is the ratio of the total amount of dividends paid out to shareholders relative to their net income of the company. The percentage of earnings paid to shareholders in dividends. The amount that is not paid to shareholders is retained by the company to pay off debt, keep cash reserves, or reinvest into the business. So for example, we had Apple is only using 18.5% of previous net income to pay their dividends, where AT&T is using 66% of their net income to pay their dividend. So for example, if AT&T HBO Max subscription site like Netflix completely failed and no one was watching, the loss of HBO Max income could lead to a payout ratio going up towards 100% or even worse. Some stocks in the market currently pay over 100% of their net income, which means they can't even cover the dividend and often take out an extra loan to keep paying the dividend or use up cash reserves that is not sustainable, which can lead to the company's share price dropping and lead to bankruptcy if they can't fix their income issues. Dividend investing allows you to create a stream of income in addition to the growth in your portfolio market value from asset appreciation. So generally the main way to make money on a stock for it to rise above your cost price. So for instance, if you bought Disney at $100 a year ago and currently it sits around $180, you would have made a profit of $80 per share. But this is not guaranteed until you sell. And on the flip side, if you bought GameStop at its highs of $468, as you can see here, which was just over 3 weeks ago, and now has dropped to around $40, so you could have made a loss of $428 per share if you hadn't sold, which can easily happen if you buy into the hype of the stock and not its fundamentals. And when I'm talking about fundamentals, these include positive net income, revenue stream increasing, are they growing the business, purchasing other companies, buying their shares back so you own more of the company as their shares are outstanding. Most of the more consistent long-term investors have a good idea when to sell or just avoid a hype stock. Tesla is the exception to the rule, but I wouldn't be surprised if that stock had a major drop in the future. Now know a little bit about what is a dividend. Let's look at some strategies that can be used to make more money from dividend investing. First is what we call a DRIP, Dividend Reinvestment Plan, where some investment apps and websites allow you to automatically reinvest the dividend back into the same company, which over time can lead to doubling your stock, just with reinvesting the dividend over a long-term horizon. A lot of people like this option, especially passive investors. Maybe look once a month, a couple times a year at their stocks, as it simply is hands-free investing. Option 2 is to reinvest the dividend into other stocks. This is the option I favour, as at any time one particular stock could be at a lower level price of its highs. In the stock world is called a margin of safety. It can be pretty technical, as so many people have different ideas on the margin of safety. But just to simplify, if a stock has a high of $100 and has fallen to $50, some people will say that would be a 50% discount. I don't agree with this logic, as a company could be slowing down in growth opportunities or losing money. What I like to do is use revenue versus expenses. If revenue is going up each year and the expenses are dropping at the same time, it is what I'm looking for in a more steady, well-established dividend company, as this means their management team is looking after you as the shareholder and the business. As I spoke about before, the payout ratio, can the company afford to actually pay the dividend, is part of what I'm looking for in dividend stock investing. Going back to the margin of safety, basically finding a company that you're currently invested in that is undervalued compared to its earnings and share price, with a margin of safety ideally of 50%. Or more, but even 20% is fine if your projection for the stock is to rise over time. I'll give you an example, using Disney stock again. This is a company I own, so make sure you do your own research before buying any stock. Had dropped to $85 in March last year and has now recovered to around $180. So my margin of safety price currently is $100, as I think it's worth $200 currently. But I also see this stock going to $500 if they can take over Netflix. Their strategy right now needs improvement. I suggest Hulu become integrated into Disney Plus and have more adult content. Netflix could be gone in 10 years time. Sadly for Disney investors, they have cut their dividend completely, so no longer a dividend stock, at least for the next year or so. So this is one of many companies that cut their dividend during the Rona, so it's always a risk you take when you're using a dividend strategy to buy a stock. That a company can get rid of their dividend at any time when times are tough for a company. But long term, my margin of safety for Disney is around $250, so buying now on a long term basis could be a bargain. The third dividend strategy is to buy only dividend stocks to eventually live off the dividend. Most people on YouTube say $50k a year is enough to live off. I'd rather live without complete worry of around $200k a year. That has real financial freedom. Being able to pay for the doctor, the dentist, any emergencies that come along, can go on a holiday and buy a nice car if you wish. For $200k a year in dividends, you would need at least $6 million invested at 4% a year. So say you retire at 50, not investing any more money into the stock market after tax, you would get a return of around 3% return each year. If you still work and keep adding more money, well, that return can go up to 4 or 5% each year if putting decent money away. The fourth and final dividend strategy is buy only higher yield stocks, 7% and up, and watch your money double in 14 years time. This strategy is high risk, high reward. Many of these stocks are on the decline, including oil companies like Royal Dutch Shell and BP, smoking tobacco companies Philip Morris. These companies give high dividend yields to keep investors happy to stay in the stock, which for an investor who's been in the stock 20 years or more could feel very loyal to the company and not sell their shares, which can be a mistake, as you could reinvest that money somewhere else. For instance, if you brought into AT&T, which is around 7% dividend yield, If you had 100k of shares in that stock, you would receive $7,000 a year in dividends. You'd get 98k in 14 years time. 2k off paying your initial investment back, but when you include tax on your dividend of around 15% or more, it's more like 20 something years to see 100% return on your money. What are the pros and cons to dividend investing? The pros: receive constant money throughout the year, mostly every 3 months. You will receive a dividend, but varies between companies. Dividend paying stocks are normally well established companies that make more money than they can use to grow their company. Extra stream of income, mostly passive money you don't have to put much effort into. Can one day retire and live off the dividend. Cons: taxes. You're taxed every time you are paid a dividend, around 15%, compared to growth stocks that are more volatile, but the good thing is you only pay tax when you sell a stock that doesn't pay a dividend. If you are holding the stock long term, 20 plus years or for a lifetime, then taxes is not really an issue until you sell. Dividend is not guaranteed. The company can remove it at any time and are not obliged to pay a dividend, compared to a term deposit or bond where they must pay back at maturity unless the bank is bankrupt. So much safer than a dividend. Another con is appreciation on a stock is generally limited. Most dividend stocks, as they only provide consistent steady growth compared to companies like Tesla, Amazon, Beyond Meat, Netflix and Airbus that are still growing their business. What are some dividend stocks that you can do more research on? AT&T with 7% dividend could be a safe long-term stock, but have a lot of debt on their books. Apple is mainly a growth stock, but also pays a small dividend, but at less than 1%. You would have to at least 4 times their payout to be more interested as a dividend play by itself. Food companies tend to have a solid dividend like McDonald's and Domino's Pizza. FedEx and Microsoft have recently joined forces and both pay a dividend. You can take a risk on a tobacco or oil stock as they are not in my lane as a long-term investor growth strategy. Dividend investing is one of many ways to make money on the stock market. I will have many more videos like this coming up to help you understand the stock market better. I hope you learned a lot about dividend investing through this video. You're welcome to leave a comment on other videos you would like me to make. Remember to smash the like button and subscribe to the channel. Barry Charles signing off. Happy dividend investing to you all. Have a great day.